Expert podcast of 2013, brought to you by financial expert Glyn Owen and James Clemster of London-based Momentum Global Asset Management. Following a rollercoaster 2012, Glyn and James report a very strong start to the year for risk assets, especially equities. On the back of this, Glyn and James explore whether the great rotation, that's when small investors get out of bonds and into equities to power a bull market, has begun. We hope you enjoy listening to Momentum's view, and if you have any questions arising from it or on any of our website content, please don't hesitate to give us your feedback via the button at the bottom of the video screen. In the meantime, have a great month.
Glyn, welcome to the year 2013. Quite a positive start so far.
Very good start to the year, yes. Equity markets up by 5%, a little bit more than 5% in the developed markets. A really very powerful run, continuing the run that has started in the latter part of 2012. In contrast, emerging markets not doing quite as well, but still up for the year, up 1.5% or so. So all round a very strong start for equity markets, although the contrast, of course, is with bond markets, which slipped somewhat. The developed markets, the safe haven government bond markets, all saw slightly higher yields. So we had returns of -0.5% to -2%. So very, very good start to the year in equity markets.
Great. That theme is one we'll come back to later, the so-called Great Rotation.
Yes.
In the meantime, let's look at the sort of dying embers of last year, the fiscal cliff agreement. That really set the scene for a good start to the year.
Yes, I think that was a very important thing that helped markets start the year so well. There's no doubt about that, because looking back, we had that big market wobble in November time. People were worried about the fiscal cliff. Of course, in the end, although it was a sort of last-minute deal that was done, the cliff was obviously averted. Although there are still some negotiations to come, essentially the big fear of a 4% fiscal contraction in GDP in 2013 has been averted, and the market sort of breathed a big sigh of relief. So that, I think, was the single most important thing that enabled markets to perform as well as they did, although there were other factors that helped. The Chinese economy came in with better numbers than people anticipated, and generally speaking there was a series of sort of good news on economies generally, which made people feel that global growth was going to be improving as this year goes on.
And against that backdrop, the corporate sector continuing to look reasonably strong.
Corporate sector in very good shape. We know the corporate sector has been cash rich and has remained cash rich. Margins have stayed quite high, although competitive conditions have been tough. And the results that have been announced so far this year for the second half of last year, the fourth quarter and the second half, have generally speaking been a little bit better than anticipated. So the corporate sector, I think, is a really important driving force behind this. It remains in very good shape financially.
Another interesting driving force over the course of the month was Japan. Lots of change there.
A lot of change in Japan, yes. Well, Japan was the leading performer amongst the stock markets in January. It was up almost 10%. Only some of the peripheral European markets matched that, compared with the rise in the MSCI World of about 5%. So it was a very strong performer, and there is no doubt that we are seeing quite a significant sea change going on in Japan. The election of the LDP government under new Prime Minister Abe late last year has produced a very significant change already in two respects. First of all, there's a fiscal stimulus package that was announced during the course of January, about 10 trillion yen. That is over 2% of the economy. We're going to spend it on infrastructure maintenance and renewal, rather than the sort of classic thing for the last decade or so when they spent money fiscally, it was on bridges to nowhere, so no great productive capacity. This time it's going to be more productive. They're talking about serious reforms to the economy. And then I think a very significant thing is that the new Prime Minister has put intense pressure on the Bank of Japan, which has probably been the most reluctant of the big four central banks to enter into serious quantitative easing, put intense pressure on the Bank of Japan to move to a much, much looser policy. And indeed, that's exactly what happened. So during the course of the month, the Bank of Japan increased its inflation target from 1% to 2%, very significant move, and announced an open-ended, unlimited asset purchase program. In other words, it'll buy bonds and paper indefinitely until it reaches its inflation target. So it's a similar program to the Fed, and we now have all the major central banks, the Fed, the Bank of Japan, the ECB and the Bank of England, all engaged in very, very loose monetary policy, a very big underpinning for markets this year.
Coming back to one of the central banks there you just mentioned, the European Central Bank, broadly speaking, looking at Europe, things appear to be in better shape these days.
Well, there's no doubt Europe's in a lot better shape. If sitting here a year ago, most people at that stage would have expected that Greece to have probably exited the euro by now. That's off the agenda. Greek government bonds, incidentally, have fallen in yields from about 30% to 10%. Has been one of the outstanding asset classes in the last few months. And there's now a general expectation that the euro will be preserved at least for the foreseeable future. And we're seeing some of the reforms that have been implemented in peripheral Europe really beginning to have quite an impact. So we are definitely seeing the benefits of all of that. Intriguingly, though, it's something to watch out for as this year progresses. On the back of all of this, the euro has been really quite strong. Against the dollar in the past 6 months, it's up about 13%, including a rise of about 3% in January. Against the yen, extraordinarily, the euro has risen by about 35%. So that's quite a loss of competitiveness, of course, over that period of time. And I'm sure that the authorities in Europe and the ECB don't want to see this continuing. What they do need is for Europe to be very competitive globally. So I think that's just something to watch out for. But certainly, generally speaking, the progress in Europe has been better than people anticipated. And I think that's given people confidence about the euro being much less of a risk. And as I say, the talk of an implosion in the euro and the euro collapsing is really off the agenda for the time being.
Against that backdrop, then, a lot of positive news macroeconomically, if you like. The Great Rotation is a very popular theme today. What does that mean for investors, and do you buy into it?
Yeah, look, it's a very big issue, and the Great Rotation is being widely talked about. By that we mean people switching out of bonds, which have enjoyed a 30-year bull market in safe haven government bonds, US Treasuries, UK gilts, German bunds, a 30-year bull market with yields at extraordinarily low levels, of course, which we have been saying for some time. Whilst over that period of time, over the past decade or so, equities have done very little, and people are now saying, well, it's the end of that long bull market in bonds. There's some fears that the bond market could be in a bubble. I don't think that is the case, incidentally. I think there's no question that government bonds in the safe haven countries are poor value, but I think it's more likely to be a sort of an orderly deflation of that over a long period of time. Because remember, we've still got the big central banks buying these bonds. They're still supporting those bond markets. So having said that, I think there's every likelihood that the outperformance that we saw last year of equities over bonds will continue through this year, albeit with a few bumps on the way. We would certainly expect to see very, very modest, if not even slightly negative returns from government bonds this year, whereas equities we expect to produce reasonably good positive returns. So the Great Rotation is underway, very difficult to judge. We are beginning to see some flows in mutual funds, into equity mutual funds, out of bonds, very early stage stuff. But I think there's a pretty good case for saying that switch that we're beginning to see will continue as this year goes on.
Despite that, though, the markets have come a long way in the last 6 months, a long way even in the last month. Is it worth just being a little bit cautious in the short term?
Yes, look, it's certainly worthwhile keeping in mind with this perspective that since the middle of last year, from around about the time of Draghi's famous "we'll do whatever it takes" speech, the MSCI World is up about 25%. It's a big move. Now, it's certainly fair to say that some of the big tail risks that we talked about through last year are less critical today. We've talked about the fiscal cliff that obviously didn't occur. Europe is in a better situation than it was. So some of those big tail risks have been diminished, but nevertheless there are still some problems out there. The fact is Europe is still in recession. There are still problems with the banking sector in Europe. The US didn't fall over the cliff, but there are big negotiations to come in terms of sequestration, which is coming up at the end of February. Then there's the debt ceiling itself at the end of May. All of that has got to be addressed, and I think those sorts of things could well cause bouts of nervousness. So I think it's an opportune time, with markets having done as well as they have and having had this terrific start to the year, just just to introduce a note of caution, take a little bit of risk off the table. Still bullish over the next couple of years for equity markets and think that they'll make good progress over that time. But at the moment, it's time to be a little bit cautious shorter term.
Brilliant. Thanks, Glenn.